Everyone, I hope you're having a great freaking Sunday. We are back at it again. I decided to come out of the shadows, out of the woodworks, out of hiding to make another long form video. And today I want to talk to you about inflation and a number of factors, but most importantly, some strategies that you can use to protect your wallet, your balance sheet, your net worth, and most importantly, your wealth from the negative impacts of inflation. So, it's been in the news a lot for the past few weeks, months, and years, ever since the pandemic happened, where the Federal Reserve came out and released unexorbitant amounts of stimulus into the economy. Prices are going up. Inflation is higher, and your amount of dollars that you get from your job is getting you less and less far on a daily basis. And to better navigate through this macro environment as the Fed is raising rates to try to cool down the rate of inflation in the economy, it's important to start by understanding what inflation is from economic perspectives. And to that end, let me tell you right now, inflation is an economic phenomenon that erodes your purchasing power of your money over time. As an example, and more pertinently, as prices rise, the value of your savings and investments are going to diminish. Now, to safeguard your wealth and to maintain your financial security, it's crucial to understand the impact of inflation on your finances and to implement strategies to protect your wealth. In this video, in more detail, I want to explore the effects of inflation, discuss its implications to your financial goals, and to provide actionable strategies to mitigate its impact. Now, my perspective has always been by taking proactive steps to combat inflation, you can ensure the preservation and growth of your wealth regardless of whatever economic environment that you're within. Now, inflation, as we just mentioned, is referring to the sustained increase in the general price level of goods and services in the economy over time. It can be caused by many factors such as excessive money supply, think the stimulus checks during the pandemic, increased production costs, think of the supply chain issues during the pandemic, or the fact that wages go up, so producers need to pass on those additional costs to consumers via the price of the goods that they're selling to us. And more importantly, I think the just general supply and demand dynamics, as those impact each other, as there's less demand, then supply will be too much, prices will go down, and inversely, and this is the cause of inflation, if there's consistent demand and consistent supply, inflation will remain flat, but if demand is far out surpassing supply, then you will have increased prices as producers try to sell out a set number of goods to a larger and larger number of people, whom of course are willing to pay more than the last guy behind them. Now, inflation has a number of negative impacts on your wallet share, but I want to talk to you firstly about positive impacts on your wallet share. Now, provided that you're having your money put into something that is going to beat the rate of inflation, therefore meaning if inflation's at 2% and I have a bond that is yielding me 5%, after you account for inflation, 5 minus 2 is 3, so your real return is going to be 3%. And, for a lot of people, seeing the balance on their investment account go up makes them happy, even if they don't realize on a real dollar basis it isn't actually going up higher, meaning when assets in an inflationary environment are able to keep onto that pricing power, the dollar denominated value is going to go up and people get some benefit out of that. But inflation really is an insidious tax on the poor, meaning those who don't have assets. One of the first negative impacts that it has is on savings and purchasing power. Now, inflation erodes the value of your saving over time. If interest earned on your savings doesn't keep up with the pace of inflation, just like I was talking about before, your purchasing power is going to be diminished and your financial goals are going to be harder to achieve. Secondarily, investments are negatively and potentially positively impacted by inflation depending on the underlying asset class, but inflation can seriously impact your investment returns. While some investments may provide a hedge against inflation, you can think of gold or Bitcoin or cyclical stocks, depending on the industry that they're within. Others may struggle to keep up with rising prices. You can think of a fixed good, which people do not have the ability to increase their spending over. I think as an example, housing costs. They make up a big portion of people's monthly expenses, and a 30% increase to your rent is probably going to be something that you are not able to sustain, at least if your income is fixed, right? Now, it's crucial to choose investments that can outpace the pace of inflation to protect and grow your wealth. In that example that I was talking about earlier, if I don't have a real rate of return higher than the inflation rate, then you're in a sense wasting your money, because on a dollar denominated basis from one time period to the next, you'll actually have less money than you did before. Now, thirdly, inflation is actually very positive for debt, meaning if you have fixed rate debt, inflation is going to erode the real value of that debt over time. However, if you have variable rate debt, interest rates may rise with inflation, increasing your debt burden. And to quantify this, let me give you an example here. Let's say I bought $1 million home at a 3% interest rate, and I am paying that on a monthly basis. The rate is fixed for the entire 30-year term. Now, let's say inflation is at 2%. So each year, 2% of whatever debt that I have on has essentially been eroded because the money supply, or the amount of money that is used to give people wages and denominate your stocks and denominate the dollar, is less. The value, or the purchasing power, or the amount of real dollars to be paid back on a debt perspective is good when inflation is high. Whereas inversely, when inflation is low, or we're actually in a period of negative inflation or deflation, the value of your debt is actually much more impactful because each dollar has an increasingly important and large purchasing power, and by paying down debt, it could have been spent elsewhere in the economy to give you a greater rate of return. So in short, investments are negatively impacted by inflation, debt is positively impacted by inflation, and it's important for you to strategically balance out both of those two factors, your investments and your debts, accordingly in whatever inflationary environment they are within, to ensure that you continue to get a rate of return through the long period of time. So getting into the meat and potatoes of this video, now that we have a better understanding as to what inflation is, let's talk about some strategies to protect your wealth from inflation. The first one is to diversify your investments. Diversification is key to protecting your wealth from inflation. By investing in a mix of asset classes such as stocks, bonds, real estate, and commodities, you can have a degree of sensitivity to inflation, and this allows you to offset some losses in some areas of your balance sheet with gains in other assets of your balance sheet. A clear example could be I have a portfolio or a balance sheet of cash, stocks, bonds, real estate. When an inflationary period is high, my cash is going to perform poorly on an inflationary basis. My stocks may or may not. My real estate will do well. My bonds will do poorly. And accordingly, the balance sheet will be leveled out by the allocation to many of these different asset classes in different percentages because they're always impacted in a different way by inflation. Whereas if you just had cash in your balance sheet in a high period of inflation, remember going back to the purchasing power example, each one of those dollars, if not reallocated into something else, is going to be able to purchase you less stuff, meaning you're negatively impacted. So diversify your assets. Now, number two, you can invest in inflation-protected assets. There are some assets out there such as Treasury inflation-protected securities TIPS or inflation-linked bonds, which adjust their value based on changes to inflation, providing a measure of protection. Real estate is another good example of inflation-protected assets because the value of real estate on a historical basis is generally consistent, appreciating at a 2 to 3% clip on an annualized basis, provided that there isn't a major housing downturn or due to larger economic factors. The value of those dollars are going to be in line with inflation or oftentimes outsurpass them, right? Now, the third thing is to maintain a balanced portfolio, and this goes back to the first item that we talked about, diversification. You need to ensure that your portfolio is appropriately balanced based on your risk tolerances and your financial goals. A well-balanced portfolio includes a mix of inflation-protected assets, real estate, TIPS, etc., and growth-oriented assets to help counter the effects of inflation. When you have all of your eggs in one basket, maybe that egg's gone rotten, and accordingly, you want to ensure that you have a variety of eggs in your basket, so if any single one does poorly, if it is a quote-unquote rotten egg, the other ones in your basket can still make sure you have a meal, right? Now, real assets, and this is going to the real estate example that we were talking about, have historically shown resilience against inflation, and investing in these assets can provide a tangible hedge against rising prices. I'm going to rattle off a few examples of real assets here just to give your brain something to chew on as you think about this throughout the coming days and weeks. Gold is a real asset, silver is a real asset, real estate is a real asset, art is real assets, commodity is real assets, and commodities are something that is tangible, fungible, there's a fixed supply within the economy, and they're sold for a set price based on market demand forces. You can think things like corn, wheat, sugar, wood, steel, stone, diamonds, etc. By investing in real assets, because they have a fixed supply, generally speaking, and a market based on demand and buyers and sellers, their prices are going to be beating the pace of inflation, or at least matching with them, because the underlying base and how we actually determine the value of those assets is done on a dollar denominated basis, and accordingly, as the money supply goes up or purchasing power goes down, everyone is stuck in the same boat, being able to purchase the same amount of said commodities. Real assets are a game changer, and in my perspective should make up a 5 to 10% of your portfolio. Real estate is a really good example if you don't want to take on the volatility risk of a harder commodity like gold, right? Now, another way to beat inflation is by investing your assets in income-generating investments. Now, of course, when you buy or sell something, you're going to have something on your balance sheet, which the goal is to sell it for a higher price later on down the line. But that doesn't mean that asset should just sit on your balance sheet and not actually do anything to produce you income. And this is where things like dividend stocks come into play. Bonds that give you a monthly coupon, real estate giving you rent collections, things along those lines. Now, the more income that your asset is going to be generating, the higher of a risk it can be considered depending on the underlying source of it is. There's something in the stock market called a yield trap where a stock will be yielding a dividend yield of say 10 to 15%. And you may be asking yourself, well, how can they sustainably do that over a long period of time? The fact of the matter is that they can't. Many stocks do not and should not have a yield that high. What ends up happening is they may have a more conservative yield upon origination of that investment, say 3 to 4%. They'll maintain that amount of income or dividends produced for the investors over a long period of time, say 5, 7, 10, 15, 20 years. But the underlying value of that asset, which it gives you right or the ownership or the ability to collect upon those payments, has gone down. And in accordance, because the amount that they're paying out remains fixed and the underlying value of the asset went down, your percentage yield in terms of dividends divided by value of the stock has gone up. However, the reason why those underlying assets have gone down in value is because there might be some kind of issue with the company. Maybe they're not making enough profits. Maybe they've missed a revenue number that they had reported. Maybe there is a negative catalyst in the news that had declined the value of the stock. And accordingly, many of those assets with very high dividend yields are not the ones that are going to be able to maintain them into the long term. So you need to be careful when you're thinking about investments with a high dividend yield to ensure that they will be able to go up and sustain their value into the future. Now, the last thing you can do as a kind of aside to all the talking points that we had gone over so far is to continually review and adjust your financial plan. My suggestion is on a quarterly basis, take a Saturday or Sunday, have a cup of coffee, look at your portfolio, read about the different investments, see if there's been any negative news or catalysts that have been going on which can negatively impact your rate of return, and rebalance accordingly. Sometimes some parts of your portfolio are going to do phenomenally well, and at that point it's always recommended to take profits, reallocate them to balance out your initial investments to the plan that you had set when you had started investing. Now, of course, there's a lot of benefit and value to potentially not selling those assets and allowing them to continue to appreciate over the long term. But going back to the point of diversification, which we've spoken about before, you never want one large part of your portfolio to make up a larger and larger percentage, which wasn't your intention. So accordingly, perhaps sell some of the stock, use those proceeds to rebalance or buy more of the other assets on your balance sheets. Now, guys, I hope this video was helpful. Be sure to like, subscribe, and let me know your thoughts in the comments. I want to conclude by saying inflation is an ever-present economic force that can erode the value of your money over time. You need to continually research and understand the impact of inflation on your finances and to begin implementing strategies to protect your wealth, as it is going to safeguard your financial future. Diversifying your investments, investing in inflation-protected assets, maintaining a balanced portfolio, and considering real assets and equity investments are all effective ways to mitigate the effects of inflation. But by staying proactive, regularly reviewing your financial plan, I'm sure you can navigate the challenges posed by inflation and to ensure the preservation and growth of your wealth in the long term. It's our belief that inflation is not a feature, but it is a feature, not a bug in the American economy. We can root its history back to the 1980s and arguably far before then as far as monetary policy and getting off the gold standard. And we know that inflation isn't going away anytime soon. Real assets like real estate, commodities, gold are inflation resistant, but more importantly, I want to bring your attention to Bitcoin and the link down below for Strike. Strike is a layer 2 Bitcoin scaling solution platform, which is going to allow you to get easy and low cost access to Bitcoin. While of course you need to do your research and make your own investment recommendations, as this is not financial advice. I'm not a financial advisor, so again, what you choose to do with your money is of your own concern. But as far as myself is concerned, I use Strike to purchase Bitcoin to diversify my balance sheet. Check out the link below for a $5 coupon for some Bitcoin, get you some free money just starting off the day. And on that note, guys, turn your rags into riches. Be sure to continue to work hard and let me know your thoughts down in the comments. We will talk soon. Have a great rest of your day.